Welcome to Alpha Insights. I'm Gareth, your trusted guide in the world of finance. Today we're diving into the recent changes surrounding Netflix's stock, especially after a recent move by TD Cowen. Joining me is Rahul, an emerging market specialist with a knack for breaking down complex finance topics. Rahul, great to have you here.
Thanks for having me, Gareth. Excited to dig into Netflix today.
Absolutely. So let's get right into it. TD Cowen just maintained a buy rating on Netflix but slashed their price target significantly from about $142 to $115. What do you make of this move?
It's really interesting. While they kept the buy rating, lowering the price target signals some caution. It suggests they see potential but tempered their expectations about how high the stock could realistically go in the immediate future.
Right, and this comes just ahead of Netflix's earnings report scheduled for January 20th. Why is that particularly relevant?
Earnings reports are critical moments for any company, but especially for a high-profile name like Netflix. Investors are eager to hear about subscriber growth, revenue, and guidance for the future. These factors can really influence stock price direction.
Speaking of numbers, Netflix's stock is trading in the low $90 right now, and considering it peaked at over $134 within the past year, it seems there's quite a gap. How should investors interpret that?
That gap certainly tells a story. It shows that the stock is below its high, which might indicate room for growth, but also emphasizes potential risks. If Netflix doesn't meet or exceed earnings expectations, we could see further declines. Investors should be cautious.
Absolutely. You mentioned subscriber metrics earlier. How crucial are those going to be?
Very crucial. Subscriber numbers can tell you a lot about the brand's health. An increase may suggest strong content performance or success in expanding their market. But if numbers drop or stagnate, it raises big questions about future revenue and growth.
Got it. And with Cowen's price target ranging from $77 to over $150, what does that say about investor sentiment?
It reflects a lot of uncertainty. The wide range indicates differing opinions on Netflix's growth trajectory and profitability. Some analysts are very optimistic, while others are cautious, reflecting a debate about Netflix's future capacity to maintain margins and grow its subscriber base.
So what's your advice to investors as they navigate this landscape?
Monitor the upcoming earnings report closely and pay attention to management's commentary. Any revisions in analyst forecasts post-earnings can significantly affect market sentiment. It's important to have a measured approach. Don't rush into decisions based solely on hype.
Excellent insights, Rahul. Before we wrap this up, can you summarize the key takeaways for our listeners?
Sure. First, while TD Cowen maintains a buy rating, they've cut their price target, indicating caution around the stock. Second, keep an eye on the January 20th earnings report for key subscriber metrics and revenue projections. Finally, the wide range of analyst price targets reflects a mixed sentiment. So, stay informed before making investment decisions.
Fantastic. Thank you, Rahul, for joining us today and shedding light on Netflix. It's always a pleasure to have your perspective.
Thanks for having me, Gareth. Looking forward to next time.
And thank you to our listeners for tuning in to Alpha Insights. Remember to stay informed, make wise decisions, and we'll see you next time.